Welcome to the deep dive. Today we're plunging into, well, a really fascinating topic, I think. It gets right to the heart of expertise, especially in dynamic fields.
Hmm.
How do the very best performers navigate, the inevitable failures? Specifically, we're looking at top portfolio managers in the Indian mutual fund industry
Yeah.
and how they handle both their big wins and, let's face it, their tough losses.
It's so easy, isn't it, when you look at those long-term track records to just see the impressive numbers, shiny results.
Right.
But the reality, and it's laid out pretty starkly in the sources you shared with us, some really insightful reports and research on these highly rated managers, is that mistakes, well, they're just a fundamental part of the process.
Exactly. I mean, nobody gets it right 100% of the time,
Mm-hmm.
especially not in markets as complex and, frankly, fast-moving as India's.
No way.
So our mission for this deep dive is to kind of dig into these sources. We want to extract those crucial insights. Like, what is it about these managers' approach that lets them succeed despite the misses? How do they actually think about failure? And maybe most importantly, what can you, the learner, take away from their experiences?
Well, the core idea, and it runs right through this material, is that investing, it isn't really a game you win by just avoiding losses completely.
Okay.
It seems it's when you win by having, first, a really robust framework, then the discipline to actually stick to it,
Discipline. Right.
and the conviction to make bold calls sometimes, but maybe most critically, the ability to learn aggressively from when things, well, when they don't go as planned.
It's that resilience then and adaptability. That seems to be the real differentiator.
I think so. And the sources give us examples from both sides of the coin, equity and fixed income, which is great, actually.
Yeah, good point. It shows these principles aren't just, limited to one asset class.
Exactly. So let's unpack that, maybe starting with the equity world. Sankaran Naren, he's a prime example, a name that's pretty much synonymous with value investing in India.
Right. Huge reputation. 35 years in investing, over 20 in mutual funds. CIO at ICICI Prudential AMC.
That's him. So he's got this deep-rooted value philosophy, finding those undervalued companies.
But the sources mentioned he's adaptable too.
Yeah.
Not just pure value all the time.
Absolutely. That's key. While his core is value, he's shown a real knack for capitalizing on, let's say, shorter-term opportunities when they align with his thinking.
Okay.
The reports point specifically to 2021-22. He proactively cut exposure to sectors like IT quite significantly, from 20% down to 9%.
Wow.
And basic materials, too, from 11% to 4%. And then shifted that capital into energy, increasing it from 3% up to 11%.
That's quite a rotation. And
Yeah.
how did that work out for him?
Well, that tactical realignment, the sources say, yielded a selection effect of 7.35% over that period.
Okay, selection effect. Remind us quickly what that means.
Sure. Think of it as the chunk of his fund's return that came purely from his specific stock and sector choices, so separate from just the market going up or down.
Got it. So a really substantial positive impact from that active decision.
Definitely. And then there's his long-term view on healthcare.
Ah, yes, that was mentioned too.
Yeah, based on a thesis about, improving export markets for Indian pharma companies, maybe easing regulatory issues in the U.S., plus companies launching new products.
And that conviction paid off as well.
It did. Generated a 7% selection effect during that same 2021-22 period. But what's really interesting, I think,
Go.
is the source notes he held that position even through a weaker phase for the sector in 2023. He stuck with it.
Patience.
Exactly. And then it recovered in 2024, basically validating that patient research-backed belief.
Okay, so those are some definite hits. But, like we said, even someone with that kind of track record, they have misses. Where did the sources show things didn't go quite his way?
Well, one notable example they pulled out was an investment in Vodafone Group PLC's ADRs, the American Depository Receipts. This was back in July 2021.
Right. And this was a contrarian play, buying
Yeah.
something out of favor.
Classic Naren value play. Buying an asset that was, pretty unpopular globally at the time.
What was the thinking there? The investment case.
The sources suggest it was based on, well, attractive valuations, obviously, but also the company's financial strength compared to its Indian joint venture.
Okay.
Plus, maybe some indirect exposure to a potential recovery in the Indian telecom market and hopes for asset sales boosting cash flow. Stuff like that.
And the reality, how did it pan out initially?
Yeah, initially it didn't really work. The source details how it underperformed through 2021-22. It got hit by weak revenue growth, mounting debt, competition, even leadership changes.
Ouch.
Yeah. And this resulted in a negative selection effect of about 1.15%. Now, the report does note the stock did perform better later on.
Right.
But the focus here for our discussion is on that period where the original investment thesis just didn't play out as expected. It was a miss at the time.
It sounds like some misses aren't just about buying the wrong thing, but maybe not buying the right thing, errors of omission.
Precisely. That's a great point. The sources also highlight his underexposure to the industrials and infrastructure sectors, specifically during that strong rally in 2023-24.
Which was driven by government spending and capex, right?
Exactly, that whole theme. So while the sector absolutely roared ahead, his lower allocation meant his fund kind of missed out on a big chunk of that upside.
And that cost performance.
It did. It contributed a negative cumulative active return of 3.33%. Which is basically, how much the manager's calls, both good and bad, added or subtracted compared to the benchmark over that period.
Okay, so looking at these hits and misses together, what's Naren's guiding principle? How does he handle these inevitable stumbles?
He seems very clear about it, according to the sources. Mistakes will happen. It's baked in.
Right.
His principle is about rigorous, really honest introspection after each one. The goal isn't perfection. It can't be.
So what is it then?
It's about making fewer mistakes over time while ensuring your winning calls are strong enough, impactful enough to outweigh the misses.
Makes sense.
And his overall track record, the numbers speak for themselves. A 25.5% annualized return since Feb 2021 versus the benchmark 18.2%.
Yeah.
That demonstrates the framework is generally working, right? Even with specific investments that didn't pan out.
That idea of introspection, it feels really key, doesn't it? Let's move to another equity manager then. Neelesh Surana at Mirae Asset. Also tons of experience, over 3 decades, known for a very disciplined style.
Yeah, Surana's philosophy, as the sources reveal it, is really built on a long-term orientation. He focuses laser-like on identifying high-quality companies.
Quality meaning?
Meaning strong competitive advantages, capable leadership teams, and crucially, reasonable valuations. He emphasizes a bottom-up stock selection process.
Okay, bottom-up. Driven by what factors?
Things like scalability, can the business get much bigger? High return on capital employed, that's ROCE, basically how efficiently they use money to make money. And strong cash flows, very focused on the fundamentals.
And his alpha, his outperformance? It comes primarily from picking the right stocks, not so much from timing sectors.
That's his core belief, definitely. Although, interestingly, the sources do show that this focus did lead to some misses, precisely because he wasn't rotating into certain hot sectors.
Oh, okay. Trade-offs?
Always. But his hits really seem to validate that stock-picking conviction, especially in areas that might seem, a bit unexpected.
Like those new age tech companies mentioned in the sources. You mean Zomato and PB Fintech?
Yes, exactly. That's a fascinating example, I thought. These weren't companies you could easily analyze with traditional PE ratios early on, were they?
No, definitely not. Very different models.
So the sources note he adapted his approach. He used models like discounted cash flow analysis, DCF, which tries to value a company based on projections of its future cash generation.
Right. Looking further out.
Exactly. He focused on their potential for scale, their market leadership positions, and that long-term cash flow potential.
But these stocks were pretty controversial after their IPOs, weren't they? Lots of skepticism. How did he manage that?
This is where his patient conviction really comes into play. Despite all the noise, the concerns about valuations, early cash burn, he seemed to believe in their underlying structural strengths.
I mean, how did he manage the risk?
By keeping the position sizes conservative. Smart, right? Typically below 2% of the portfolio, the sources say. So, conviction, but measured.
And that patience, it really paid off big time in 2024.
Hugely. The sources point out Zomato surged over 125%. PB Fintech rallied over 138%.
Wow.
Driven by improving fundamentals and, the market sentiment finally catching up to that long-term potential he saw. It really highlights how looking beyond the immediate noise, trusting his research, how crucial that was.
Okay, so where did that disciplined approach perhaps cause some challenges? According to the reports, were there misses?
Well, his strict valuation discipline, which is generally a strength, right? It meant he was underweight the industrial sector during that powerful 2023-24 rally we just talked about with Naren.
Ah, same sector issue.
Same issue, different reason, perhaps. While the sector delivered something like, 28%, his holdings in that space lagged significantly, returned only about 4.6%.
So a classic error of omission, again. missing a big opportunity by sticking maybe too rigidly to his valuation rules in that specific case.
Exactly what it looks like. And the sources also note similar underexposure to public sector banks and defense stocks, again, largely due to concerns about governance or the cyclical nature of those businesses.
So he missed significant upside there that maybe other managers captured.
Correct. He missed out on that part of the rally.
So how does he handle these moments then? The reports mention his process.
Yes, they describe it as involving swift corrective action when needed. If the fundamental thesis for holding a stock changes or weakens, he has a disciplined sell strategy. He doesn't hang on Hoffnungslos.
Okay, decisive.
Seems so. Decisive in responding to risks like too much leverage or industry headwinds. And importantly, he has a clear exit strategy. Selling a stock once it meets his target return, rather than getting emotionally attached or falling into that holding period bias.
Right, knowing when to sell is just as important.
Absolutely. And he's apparently quite explicit about learning from these experiences, acknowledging both types of errors, the areas of commission, the investments that underperform, and those errors of omission, the opportunities missed by staying on the sidelines, like in capital goods or defense. That self-awareness seems a key part of his overall discipline.
It's really fascinating how two top equity managers, Naren with his value-adaptable blend, Surana with quality long-term conviction, face similar challenges like missing sector rallies, but seem to process it maybe slightly differently based on their core philosophy.
Yeah, the nuances are telling.
Let's switch gears completely then. Let's talk fixed income. Suyash Choudhary at Band Mutual Fund, over 2 decades in this space.
Right, Choudhary. He's known for a, let's say, prudent, very macro-aware approach to fixed income.
Macro-aware.
Yeah, meaning he pays close attention to the big picture monetary policy, fiscal trends, where interest rates might be going. He combines that top-down view with bottom-up analysis of specific bonds, looking at both credit quality and duration.
Duration. That's how sensitive a bond's price is to interest rate changes, right?
Right.
Longer duration, more sensitivity.
That's a good way to put it, yeah. And he seems to prefer managing strategies where he can actively adjust that duration based on his view.
Okay.
And he anchors his portfolios in high-quality stuff. Government securities, G-SECs, and top-rated corporate bonds, AAA or select AA. He really sees fixed income primarily as a portfolio stabilizer. Less about chasing yield, more about managing risk.
And where did this careful approach lead to hits? Where did it work well?
Well, he's shown a strong ability, historically, to anticipate major turns in the interest rate cycle. That's a key skill in fixed income.
Right.
The sources highlight his repositioning in 2023. He anticipated factors like India's improving macro outlook and, importantly, its upcoming inclusion in global bond indices, which was expected to bring inflows.
And he positioned for potential rate cuts, too.
Precisely. He significantly increased the duration in his flagship dynamic bond fund. The numbers are striking. From about 4.45 years in August 2023, way up to 12.0 years more recently.
That's a big shift.
Huge shift, anticipating that the rate hike cycle had peaked and expecting, modest rate cuts down the line. And this positioning really helped the fund become a top performer in its category in 2024, as bond yields did indeed soften, meaning prices rose.
Makes sense. Any other examples?
Yeah, the reports also point back to his successful longer duration stance from late 2018 to early 2020. He benefited massively from the 290 basis points of RBI rate cuts during that period, led to consistent top quartile performance then too.
So clearly skilled at making those big duration calls. But again, the sources must show challenging periods too, even for him.
Oh, absolutely, he has. In 2021, for instance, his dynamic bond fund underperformed. A big reason cited was its very high allocation to G-SECs, over 90%.
Why was that a problem?
Because peers who held more corporate bonds benefited significantly from spread compression. That's when the yield difference between corporate bonds and safer government bonds narrows. He largely missed out on that because he was so heavily in G-SECs.
Ah, okay. Risk aversion cost him that time. What about his duration management that year?
That also faced headwinds, yeah. It reflected the general uncertainty at the time. The reports show he adjusted duration quite frequently, thinking the low-rate environment was ending and expecting hikes sooner rather than later. But those hikes got delayed.
So the timing was off.
The timing was off, and it led to underperformance in early 2021 when yields spiked, particularly in the 6-year maturity segment where his fund had exposure. Meanwhile, the category average duration was shorter, around 4 years, and less impacted by that specific spike.
And 2022 presented another timing challenge, didn't it? The rate hikes.
It did. He didn't, it seems, accurately gauge the timing or the sheer magnitude of the rate hike cycle that began then. He expected hikes, sure, but not the surprise off-policy move by the RBI, and the initial 40 basis point hike was larger than many anticipated.
Caught the market off guard.
Caught everyone off guard. Yields hardened, rose sharply, meaning bond prices fell, and that led to fund underperformance again.
So it really underscores that even experts find timing these cycles incredibly difficult. It's not about never getting it wrong.
Exactly. But the sources still underscore his overall mastery in, dynamic judgment and skill in duration management despite these specific misses. The principle seems to be that his framework generally leads him to make the right calls over the long term, delivering strong performance and reliability.
Reliability and fixed income. Okay, let's look at our final manager. Shobhit Mehrotra at HDFC, another highly experienced fixed income pro, 33 years, wow.
Yeah, Mehrotra. Heads up fixed income and credit research at HDFC. His philosophy, very disciplined, very research intensive. Combines the macro view with deep dives into individual bond issuers, the credit analysis.
And of priorities.
Top priority, capital preservation, followed by consistent income and strong risk-adjusted returns. He's known for a conservative style, big emphasis on credit quality and liquidity.
So avoiding the speculative stuff.
Absolutely. Avoid speculative credit, focuses on sound fundamentals, governance, sticking mostly to AAA and select AA-rated bonds, really prioritizing that capital preservation, even if it means maybe leaving some yield on the table sometimes.
So safety first. Where did this conservative, quality-focused approach really pay off for him?
Well, between 2021 and 2023, for example, he strategically kept funds like the HDFC Medium Term Fund and the HDFC Floating Rate Fund in shorter or medium duration instruments.
Why?
Because he anticipated that global central banks would turn hawkish and start raising interest rates, which they did.
So by staying shorter duration, he protected the funds when yields inevitably went up.
Precisely. Those funds were less sensitive to the rising yields, shielded from the worst impacts, and actually enabled them to outperform peers who were caught holding longer duration bonds.
Smart. Any other successes?
His persistent focus on high-quality corporate bonds in 2023 also really contributed, maintaining that mix of AAA and select AA, avoiding lower-rated credit. That disciplined approach led to top quartile performance for funds like the HDFC Medium Term Fund.
Interesting. Did he also make duration calls successfully later on?
Yes, seems so. The reports note he maintained a higher-than-average duration in the HDFC Income Fund during 2023-24. Similar to Choudhary in a way, but maybe for slightly different reasons within his framework.
In the rationale.
He anticipated the tightening cycle was nearing its peak, and a shift towards easier policy was probably coming, supported by things like moderating inflation. That strategy paid off as yields did soften, contributing to strong performance in 2023 and 2024 for that specific fund.
Okay, but what about the periods where this cautious approach was maybe less beneficial?
Yeah.
Or did it hold him back?
Well, in funds like the HDFC Credit Risk Fund, his deliberate avoidance of higher-yielding, lower-rated bonds meant he lagged behind peers who were willing to take on more credit risk.
When did that happen?
Particularly true in 2021, 2022, and 2023. While his focus on quality was great protection for investors during tough times, like the credit events of 2019-2020,
Right.
he underperformed when market conditions improved, spreads narrowed, and those riskier bonds rallied strongly. His funds didn't participate as much.
So safety helped in the downturns, but kind of hurt in the rallies. A trade-off again.
Exactly. And like Choudhary, he also had a duration miss in the HDFC Income Fund back in 2022.
How so?
He was positioned for a more benign policy environment. He expected the RBI to keep supporting the post-COVID recovery, but inflation surged unexpectedly, the RBI had to tighten aggressively, yields hardened significantly.
And his longer duration position hurt.
It did. The fund lagged its peers quite a bit during that period.
His core principle, then, it seems really deeply rooted in stability and capital preservation above almost everything else.
That's definitely the key takeaway from the sources on Mehrotra. His focus is unwavering on portfolio stability, prudent risk management, even sometimes at the cost of sacrificing potential short-term gains from taking more risk.
It's about that long-term consistency and focus on protecting capital first.
That seems to be the defining characteristic of his approach and track record.
Okay, this is great. We've looked at these 4 top managers, 2 equity, 2 fixed income, seen their different styles, their big successes, and crucially, their inevitable missteps. Here's where it gets really interesting, I think. What is all this, these varied experiences, what does it tell you, the listener, about navigating complex domains, not just investing.
Yeah, I mean, the sources provide some really powerful common threads when you look across all four.
Like what?
Well, they definitely reinforce the fundamental importance of having a solid research process and sticking to your framework, whatever it is, value, quality, macro forecasting, credit analysis, doesn't matter.
Discipline?
Discipline, they also show the value of conviction. Sometimes you have to go against the prevailing market sentiment if your research backs it up.
Sure.
And they absolutely underline the importance of taking a long-term perspective, not getting whipsawed by short-term noise.
But the most compelling lesson, wouldn't you say, the one that comes through again and again with all these managers,
Mm-hmm.
and the reports explicitly highlight it,
Yes.
is that their success isn't built on never being wrong. That's impossible. It seems it's built on how they respond when they are wrong.
Absolutely. It's about having a process for acknowledging errors, both those errors of commission, investing in something that goes down, and those errors of omission, missing out on a clear opportunity that fit your mandate, but maybe you hesitated on, both matter.
Yeah.
And they show that honest introspection, a real commitment to learning from every single misstep, is just fundamental to refining their decision-making process over time, enhancing future outcomes.
It's not about eliminating mistakes then. It's about integrating the learning from them into a stronger approach going forward.
Exactly. You hit the nail on the head.
This mirrors the learning process in pretty much any complex field, doesn't it?
Oh.
Whether you're investing or building a business or learning a new skill,
Sure does.
it's about having that disciplined approach. You form a thesis, you test it out in the real world, and then you critically analyze the results, especially when they don't go the way you expected.
Yeah. Understanding why something failed is often just as, if not more, valuable than understanding why something succeeded. That's where the deep learning happens.
So to kind of sum it up from these sources, the idea of a perfect portfolio manager, someone who never errs,
Yeah.
it's a fantasy, basically.
Complete fantasy. The true measure of their expertise isn't infallibility, it's resilience. And having that framework that allows them to compound knowledge from both the wins and the losses.
Their long-term outperformance, then, is a testament not just to their foresight, but really to their underlying discipline, their conviction, and maybe above all, their unwavering commitment to learning from everything the market throws at them.
Well said. This deep dive into these managers' experiences really shows that in the complex world of finance, and probably in many aspects of life, and learning too, resilience and that continuous learning loop are just as vital as raw intelligence or initial skill, maybe more so over the long run.
So let's bring it back to you listening. What does this all mean for you? Maybe consider this thought. The sources make it crystal clear that acknowledging mistakes honestly is absolutely key to enhancing future returns in investing. How might that same principle, this idea of honest analysis, really digging into and learning from what didn't work, how might that apply to your own learning process, or your decision-making, or just navigating challenges in whatever area you focus on?
It's a powerful question. Well, thank you for bringing these fascinating sources to our deep dive today. Hopefully this exploration gives everyone some valuable insights to reflect on.